Okay, so problem 32 is a little bit more advanced problem because here we're actually doing consolidation. Fortunately, it's just consolidation on the acquisition date, which is complicated enough, but we're not dealing with consolidation after acquisition date. That'll be next chapter. In the meantime, this particular problem sort of gives you every nuance you can get in an acquisition up through this chapter at this point. And it doesn't. The good news is the acquisition issues don't get any more complicated than we have it now. And the nuances are that stock was used to buy it. They used all stock, and they have as a contingency. They've had a cash payment, which will be paid a year later at the end of December 2015. And that's going to be valued, again, like in last problem, it's not going to be valued at 100% because this problem is just different than the real world a little somewhat, in that this particular contingency has only a 50% probability of being successful. So we're going to discount its present value based on a 50% probability, and you'll see that when we get there. The other thing that the problem has is it has stock cost related to the issuance of the stock, so that's going to need to be accounted for separately. And we also have a research project under development where we're given the value for that. So the first thing we'll do right now is let's just get the opening entry, the acquisition entry, which in this case will be an investment debit on the books of the acquirer or the acquisition company, because we are keeping the separate legal identity status of the purchase company intact. Notice also that the problem tells you this is a 100% voting stock purchase, so this is a little bit easier than it'll get later when we purchase a little bit less than 100%. So there keeps it simple for the moment, even though it seems complicated. Here is the textbook's approach to the answer to the problem. Let's do the first part, which is the A, to answer the journal entry. Certainly, a debit to the investment account has to make sense. It's an asset that's going to be owned by the acquisition company, the parent company, if you will, Pacifica. It's an investment. Yes, it's 100%. It means consolidation, because obviously at 100% you have control, but it's still on the books of Pacifica, only an investment. The assets don't come over because the subsidiary continues to exist as a legal entity. This recognizes the common stock broken down between the par value and the paid-in capital. It's simply done by number one, knowing what the fair value of the total stock is, and they give you that. It's $20 a share, and 50,000 shares are issued, hence $1 million. 250 and 750 is still $1 million according to my calculator. But $5 goes to the common stock because that's the legal par value. That's all you do. It's just a simple mathematics. How much is the par value? That's what goes there. We don't care what the fair value is, because the difference, if there is a difference above the par value of the common stock, goes to additional paid-in capital. That's here. Goes additional paid-in capital. Bing, bang, done. The balance goes there. The contingency performance obligation is also part of the purchase price in this case, and you can see that if you go back to the debit for the investment, this represents the $1 million of the stock given plus the value of the contingency. How did they get to that? All right, so they took the contingency payment times 50% times the present value factor, and they got $62,500. That's how they did it. I can tell you right now, you will not have to answer that kind of question on any of the questions I give you. I'm probably not going to. I'm saying I'm probably with like a 99% probability that that's true. And here's my pledge: in case I mess up and give you one like that, you guys come back and tell me I messed up, and I'll fail you anyway. That's all. All right. Okay. So we're not finished with the entry because there was professional expenses related to the purchase. They tell you that there's $15,000 paid for what? Paid, I had that in front of you a second ago, paid to For legal fees, that's just part of the due diligence, so this is a debit to legal fee expense and a credit to cash. But then $9,000 was for stock issuance costs, and that goes against paid in capital. So to make sure we got this entry correct, let's do it this way. Let me redo it for you. The cash is obviously the credit, and the debit here goes against paid in capital. So the net change in paid in capital will turn out to be this. Turn out to be $750 as a credit for the new stock issuance. In fact, let's do it this way. Let's do a T account of the additional paid in capital so you can test your knowledge with this. Here's APIC, T account. I love T accounts. You know that. 750 was a credit on that we saw here. We computed it here. Then 9,000 is going to be a debit here based on this entry because it's part of the stock issuance cost. And that is that. So the net change will only be 741. And that's okay. That's the way it works. All right, let's stop there, and we'll come back with one more on the rest of the problem, which I think goes into the actual entries for the consolidating the acquisition date.